Should you or should you not buy a $1 million property based on a $10,000 income? Hi, my name is Marcus and thank you for supporting our previous video where we uploaded whether should one buy a $2 million property in Singapore. After uploading that video, we received a lot of DMs asking, can we do a video based on a $1 million purchase? First, this is going to be a long video. Skip to the next chapter if you have already watched the previous video on affordability. Let's go. Here are the three things you need to take note of. Number one, do you have sufficient funds for the down payment, stamp duty and legal fees? Number two, is your income sufficient to qualify for the required loan? And then number three, most importantly, what are the running costs that you must consider which many people missed out during the calculation? And then using these three factors, I will then share with you whether should you or should you not do it. And if you do so, what is a more prudent way to approach this situation? Now, before I continue, do help me to tap the like button because it's free and it's an act of kindness. Number one, you need to understand what is the initial capital required to purchase this $1 million property. First up, you need to understand that 5% must be in cash and the balance of the 25% can be either in cash or CPF. All in all, you need a total of $250,000 down payment for the $1 million property. Next, you also need to factor in the legal fees, which is $2,500 to $3,000 depending on which solicitor firm that you are using. Followed by stamp duty, which is a form of tax. In professional terms, it's called BSD, are taxes on documents related to either the purchase or lease of properties. So regardless of whether you are buying or leasing a property, stamp duties will apply. And it works in a very interesting way whereby the higher the property price, the percentage that will be used to calculate the stamp duty will be higher. There's actually a shorter way to do the calculation, and in this case of a $1 million property, you basically use 4% of $1 million minus $15,400 and then you will get the stamp duty of $24,600. If you'd like to find out more, I will link it in the description. Coming to point number two, your loan eligibility. When it comes to buying a Singapore property, you must always consider the TDSR, total debt servicing ratio, which limits your monthly debt repayments to up to 55% of your monthly income. Also, that includes your property loans, your mortgage loans, and also your personal credit card loans as well. Calculated at a floor interest rate of 4% and up to an age of 65 years old. But do take note, right now the banks are using this medium term or stress test rate of 4.7%. And in case if you wish to find out more about refinancing your current mortgage, do feel free to drop me a text. I'll be happy to share with you what are the latest and the best rates around. Now the question is, how much do you need to earn in order to qualify for a loan for a $1 million property? Assuming if you have a car installment of $1,400 a month, which is what you can get for a Toyota Noah here in Singapore, the answer is 10K. However, it depends on your age because your age matters a lot when it comes to calculating your loan. For example, you are at the age of 35 years old, earn a combined income of $10,000 with a car installment of $1,400. You then qualify for a loan of $858,000 and that allows you to purchase the $1 million property. The age 40 years old, you can get a loan of $776,000. And if you are 50 years old, it changes the equation because you only qualify to get a loan of $554,000. It just proves that it will get more difficult for you to purchase a property when we age. So when your agent tell you to buy early, right, it's not because they want to make the commission earlier, it's because it does matter a lot in terms of eligibility as well. Number three, what are the running costs you must consider before buying that $1 million property? Number one, of course, your monthly installment. Number two, monthly property maintenance. And thirdly, your property tax that you need to pay yearly. So these are the monthly running costs, which is a little bit more general. However, if you have other monthly commitments like giving your parents money, your children's education, or insurance and stuff like that, you will also need to consider this as well. Now, before I deep dive into an actual case study, because this video took us very long to produce and based on our analytics, more than 90% of you are not subscribed to the channel. So tap the subscribe button and if you haven't liked the video yet, do so now. Thank you. So using a $1.1 million 6 Derbyshire 1-bedroom condo as an example, your monthly installment for a 30-year loan tenure based on 4% interest rate will be $3,931. The average maintenance fees nowadays for a mass market condo is around $360 a month. Assuming your property tax annual value is $36,000 a year, your property tax, if you live in the property, will be $1,180. However, at age 35 years old, with this kind of income level, you'll be getting $1,260 monthly going into your ordinary account, that can be used for mortgage repayments, which equates to a cash top-up of $2,671. Factoring in the monthly maintenance of $360 plus $100 property tax, if you add these three components together, it will land you in a grand total running cost of $3,131 per month. Considering you need to contribute $1,200 to your CPF monthly, we will then deduct $1,200 from your pay of $10,000. That works out to a take-home pay of $8,800. So with a take-home pay of $8,800 minus $3,131, your remaining take-home pay would be $5,669 before factoring in your other expenses and commitments. So the greatest concern is whether is this considered a stretch. Let's calculate the percentage of funds allocated in this case. 3131 divided by the take-home pay of $8,800 multiplied by 100 means you're allocating 35% of your take-home pay to your property. Now, whether does it make sense to me? It does, because in Singapore, on average, the asset allocation is between 30 to 40% according to bank research. Allocating 35% of your monthly take-home pay, I would say that is pretty reasonable. And in a way, it forces one to be more prudent when it comes to your day-to-day spending. Now brings me to the final question. Should you or should you not buy a $1 million property based on a $10,000 income? The answer is no, because I always believe in buying under your means and saving for rainy days. Applying a 25% buffer on your maximum purchase price is a more prudent way to approach this. This brings me to the fact that you need to purchase something at about $750,000, and I know you must be wondering and scolding me, $750 buy what? Nothing to buy. Actually, it's not true, because I just went online and searched on Property Guru. For under $800,000, there are 567 listings available for sale for a one-bedroom, and even if you need a two-bedroom, there are actually 30 over listings for sale based on a price of under $800,000. Are there opportunities? Yes, there are, but it depends on where you have been living while we are growing up, because if you have been living in town, you won't be so pleased with the locations because they are mainly more of the suburban area. So you should consider your own priorities. Is location more important? Is size more important? If you need someone to help you to search for a house, you can always call me. I'm more than happy to assist you as well. Going back to my advice, I would say that you should consider something that is about $750,000, because based on a loan installment of $2,685, your monthly cash top-up will be $1,425 after using your OA. Adding on to your monthly maintenance and property tax at $460, the grand total works out to be $1,885. Using the same example earlier on, your monthly cash allocation will be down to 21%. And 21% is very comfortable as compared to 35%, because monthly you have $6,915 left for your other commitments, which is a more prudent way to approach this, and my recommendations if you ask me. On top of that, the balance down payment that you save between the $750,000 to $1 million property is total $70,000. It will weather you through 36 months straight without having a job and not to worry about the monthly cash top-up for your property. Disclaimer, all these calculations are general, and please do your own due diligence before making any purchase. I hope this video has been able to provide you with more insights before buying a $1 million property. As usual, like, comment, subscribe, and if you have any questions, do feel free to join our Telegram channel where I have been posting daily property news. Thank you for watching. See you at the next video.